The US dollar was, at one point, backed by gold. That was until 1972, when President Richard Nixon, quote, temporarily suspended the convertibility of US dollars into gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
He famously claimed that the move was to protect the dollar against speculators. In fact, the United States had issued more dollars than there were gold to back them up. If everyone went to convert their dollars into gold, there wouldn't be enough to go around. This violated a guarantee that the US promised its European allies and the rest of the world post-World War II. The dollar was meant to be backed by the rare precious metal. After 1972, it was backed by nothing. This was a major problem. A currency gains and maintains value through demand for it. If there is no demand for a currency, it can hyperinflate or lose value. Despite being the world reserve currency, if the US dollar was not backed by gold or anything of value, it loses its appeal as a store of value or means of exchange. Nixon knew the dollar's days were numbered and he had to act fast. So 1 year later, in 1973, President Richard Nixon and Saudi Prince Fahd ibn Abd Aziz signed a 6-page agreement that all Saudi oil would be traded exclusively in US dollars. Oil was, and in many ways is, the world's most valuable commodity, and by guaranteeing trade in US dollars, Nixon in effect was guaranteeing demand for the currency and in essence backing it with oil, and so the PetroDollar was born. In the years that followed, all oil worldwide would be sold and bought through the US dollar, guaranteeing a high level of demand and therefore value for the foreseeable future. While the powers that be in the West celebrated this deal, not all oil-producing nations were pleased. The US had an incomprehensible advantage. It could print unlimited dollars out of thin air with almost no effort or cost, and trade these for valuable, scarce oil which took monumental amounts of energy to produce. Not everyone wanted to support the United States' exorbitant privilege, and over the past 5 decades, 3 notable examples exist of countries stepping away from this system, and the consequences they faced were far from minor. The first major oil-producing nation to attempt to move away from the US dollar was Iran. It took just 6 years after the petrodollar introduction in 1973 for the Iranians to end its exporting trading in the greenback. On November 19, 1979, Iranian officials announced that it would no longer conduct international trade in dollars and urged all other OPEC member nations to do the same. Iran's Minister for Economic and Financial Affairs sought to end the US as the global reserve currency. He passionately declared at the time, "Oil money is what supports the dollar as world currency. Replacing the dollar by a basket of non-dollar currencies is the real way to put an end to their dependence." The United States had frozen Iranian assets in American banks, the same way they have done so with Russia in recent years. The president had said that this move showed that the money in legal terms belongs to the big capitalists and not the oil exporting countries. If other oil exporting countries follow this line in a revolutionary way, the world monetary system will change and the world will get rid of monetary domination by America. Just 1 year later, Iran was invaded by its neighbor, Iraq, who is bolstered by economic and military aid from the US. Ironically, Iraq is led at the time by Saddam Hussein, who we will discuss shortly. While the Iran-US dollar standoff occurred in the late 1970s, it wasn't until documents were declassified in 2008 that we got a sense as to why this may have occurred. In 1976, President Nixon and Saudi Arabia had colluded to drive low, which inadvertently destabilized Iran's oil-dependent economy. Now, as previously mentioned, Iraq was bolstered by US aid in its invasion of Iran. This brings us to our second incident of going against the US dollar system. Iraqi leader Saddam Hussein was an ally for the US and even visited the White House on occasion. However, at some point, Hussein made the decision to drop the US dollar for Iraqi oil exports. In October 2000, the euro was used as a currency to buy and sell oil from the Middle East nation. This was a huge boost for the relatively new European currency, which had faced, let's say, teething issues in its early days. Ironically, the currency hit its lowest level versus the dollar on the same day Hussein made the announcement. $1 was worth 82 euro cents that day, but the value surged 30% over the following 2 years. By February 2003, Iraq funds held in the euro also enjoyed a higher interest rate with European reserve versus what they would have earned in dollars. But almost like clockwork, in March 2003, after George Bush claimed Iraq was part of an axis of evil, US troops invaded the Gulf state. By 2009, Hussein had been killed and a bitter war over Iraq's oil began between the US and the UK. Sadly, for the citizens of Iraq, the country has never recovered since. Now, while Iran and Iraq sought to drop the dollar and found their demise. The final case is somewhat intriguing. Libya, the East African oil-rich nation, had been led by Muammar Gaddafi since the early 1970s. Under Gaddafi, Libya had become quite the success story for an African country. Citizens enjoyed low-cost or nearly free education, healthcare, and access to petroleum. Perhaps the most notable feature of Libyan civilization was the construction of the Great Man-Made River. Starting in 1984, the country built pipelines all over the nation to transport fresh water from underground deposits in the Sahara Desert to almost all major towns and cities. The project cost $25 billion and amazingly was funded solely from oil money and did not require any loans from the IMF, World Bank, or Western intervention. To be clear, I am not saying that Gaddafi was a saint. There are well-documented and widely reported incidences of what one might call undesirable behavior. But one thing he was, based on projects such as the Great Man-Made River, was an industrialist and visionary. He had a grand vision for Africa as a continent at the behest of the US dollar. In February 2009, Gaddafi was voted as president of the African Union. He announced his grand plan for the United States of Africa, which consisted of one army, a common passport, and, this is the big one, a gold-backed common currency. In fact, Gaddafi had amassed 144 tons of gold in secret and believed to have a similar amount in silver to back the gold dinar currency. 2 years and 1 month later, in March 2011, you guessed it, NATO forces backed by the US entered Libya on humanitarian ground. We now know, though, thanks to leaked Hillary Clinton email, that behind the scenes, talk of Libya was almost predominantly focused on oil and the prevention of the African continent uniting behind the gold dinar. Then French President Nicolas Sarkozy saw the invasion as an opportunity to grow his political claim, as well as stake a claim on Libya's vast oil reserves, something France has a hold on in former French African colonies in Senegal, the Ivory Coast, and others. Gaddafi was killed in 2011. Almost all of his 144 tons of gold went missing, and they have never been found since. His Great Man-Made River project, a literal lifeline for Libyan citizens and a beacon of hope to Africa, had been bombed by NATO forces in the intervention. The country today is wildly unstable, and various factions are vying for control of the oil-rich nation. So what does the future hold for anyone vying to dethrone the dollar? Well, as is widely reported nowadays, the alliance of BRICS nations, Brazil, Russia, India, China, and South Africa, want to trade in local currencies or even create their own gold-backed currency. Saudi Arabia wants to join them, as do an estimated 40 or dozen or other countries in Africa, Asia, Central and South America. In fact, international trades are already taking place in Chinese yuan, with some converted to gold via the Shanghai Gold Exchange. This causes an issue for the US dollar. Less demand for dollars at a time when there are trillions upon trillions floating around in the system would indicate inflation is to come. Recently, there has been some celebration in the Western media about the slowing of US inflation, but economists warn that past inflationary cycles run hot, take a break, and then run hot again. So what is next for the world, the dollar, the existing financial order, and the BRICS nations? Time will tell. One thing is for sure though, this time is different. Single nations have tried in the past to dethrone the dollar and face consequences. Will the same thing happen to BRICS nations? I don't think so. What do you think happens next? Share your opinion below, and don't forget to like and subscribe if you got something from this video. Thanks for watching, and see you again next time.